Most retail investors spend 95% of their time thinking about what to buy. But nobody, not even institutional investors, seriously know when to sell, as this research from 2021 shows. And honestly, I was guilty of the exact same thing. Because as long as the portfolio keeps going up, you can ignore a lot of problems. Concentration risk, valuation expansion, sector exposure, emotional attachment to winners. But April changed that for me. My portfolio just hit new all-time highs and Nvidia is again making up almost 12% of my entire portfolio. And my 4 largest semiconductor positions now make up even more than 1/3 of all of my stocks. That's not diversification anymore, that's a bet. So instead of relying on gut feeling, I built an actual decision-making framework for trimming and selling positions. And today, I'll show you exactly how this framework works and which positions in my portfolio it's already flagging. And if you're new here, my name is Florian and I'm a physics engineer from Germany with a passion for data-driven and objective investing. Welcome to the channel and thank you for joining me today. So in March, my portfolio was just slightly below 140,000 euros, split between 32,600 in ETFs and 108,900 in stocks. And after 2 pretty weak months where my portfolio was deep in the red, it has now turned around again. With 8.3% returns in just 1 month, it is now at new all-time highs. My ETFs did even a bit better than my stocks with 11.7%. The main driver for the great performance of my ETFs was the performance of the emerging markets and my digital security ETF that both went pretty well. But both of my general market ETFs went also pretty well with over 10% returns. And my largest portfolio position, which is Nvidia, went also pretty well with almost 16% returns. This has also pushed them to almost 12, it's actually 11.8% of my total portfolio allocation again. Not quite as high as it was back in November, but still pretty large and way ahead of my second largest, which is TSMC with 9%. Now, that's a massive success, but it also creates a problem. As I mentioned in the past, my portfolio is pretty overweight with tech and semiconductor positions. My 4 largest positions right now are Nvidia, TSMC, Texas Instruments and ASML. All of them from the semiconductor space. These 4 stocks alone are worth over 40,000 euros and make up over 1/3 of all of my stocks right now. Not so much for diversification. The danger is that when you hold a winner like Nvidia or ASML, it is easy to mask greed with conviction. So there is no reason to sell. But here's the thing. If you don't have an objective and predefined exit strategy, you aren't actually managing a portfolio. You are just hoping for the best. And looking at the April numbers, the concentration in semiconductors and big tech has reached a point where a single sector rotation could wipe out months of gains. So I have spent the last weeks building a systematic architecture for buying and selling. I already showed you my buying strategy last month and today I'll show you my rule set for selling and trimming. Specifically designed to take the emotions out of these decisions and make them more objective. One part of this framework is a hard 12% concentration cap. And since Nvidia is very close to that, the framework, not my opinion, says it's almost time to trim. So the plan is now on paper for Nvidia, ASML and a couple of other stocks that I'll show you later in the video. And this isn't about losing faith in these companies. I still think that all of them are excellent investments. It's purely about risk management, not about maximizing returns. But before we get into the details of this new framework, let me first show you what happened to my portfolio in April to see what this new system is going to be protecting. We've already looked at the total performance, but of course we also need to look at the cash flows. And April was actually a very decent month for dividends and a good start into my strongest quarter for passive income. And Novo Nordisk started off the month with 79,85 euros. Next came Nvidia with 68 cents. So despite them being my largest position, the actual contribution to the dividend payments is pretty low. But in this case, the yield is obviously the secondary story. On the 14th, I get 2 payments. First, 72.67 euros from VG and then 23.02 euros from TSMC. So by the middle of the month, I already got well over 150 euros, which is already more than what most full quarters earned me when I started this portfolio 3 years ago. But this is where April really started to get interesting. Because on the 23rd, Ahold Delhaize paid me almost 100 euros with 96.36 euros. And on the day after, JD.com paid 98.45 euros. So almost 200 euros in just 2 days. Not bad if you ask me. Finally, Danaher paid the last dividend on the 27th of 10.53 euro, which in total yielded me 381.30 euros last month. And all of these dividends came without any new buys or sells. It was a quiet month in terms of transactions. And all gains, losses or shifts only came from the market performance. But this has nothing to do with the timing. It's not because I think that it's a bad time to buy new stocks right now. But when you don't trade, the market does it for you. And last month, the market increased the allocation of most of my tech companies again, even without me adding any new shares. But the problem with a quiet month is that complacency can set in that starts to rot a good strategy. You see the dividends coming in, you see the allocation creeping up, and you tell yourself that everything is fine because the total value is green. But looking at these April numbers was the final nudge that I needed to finally start working on my selling framework. And that's important because most retail investors, including myself or specifically myself, have a hard time selling because I see it as an emotional admission of being wrong, or at least of being done winning. It's the psychological battle of being honest with yourself when a story starts to sour. We've all been there. The numbers look okay, but something just feels off. But I don't want to play this game anymore. So I've designed this new framework that gives me recommendations on what to sell or trim. I designed it as an objective tool for my investment style, which is essentially a combination between growth and dividend growth investing. And I've split the logic into 2 buckets: the trim and the hard sell. Each of these actions, trimming and selling, is rated across 2 categories. The business health category that takes priority over what I called the position discipline. And depending on the combination of these 2 scores, a different action is triggered. The business health category gives a warning when the core business case is broken and I should consider to stop buying or even exit the position entirely. I designed this in a way to identify red flags early and specifically prevent things that led to my biggest losses like Surgical Science, Dassault or Novo Nordisk. The position discipline, on the other hand, only shows that either my position size or the valuation of the company is too large and I should consider trimming this position. So this is more about portfolio construction and not a business failure. But how do I get to these scores? Well, in business health, I have 4 categories. 2 that are designed to judge the safety of the company and the dividend, 1 for quality, and 1 as an early warning sign that the market knows something that I might be missing. The first 2 are the dividend safety that I measure with the free cash flow payout ratio and the solvency that I measure with the net debt to EBITDA ratio. Because if any of these metrics deteriorate, it indicates that the company either has troubles paying the dividend or they have trouble with the debt ratio, which increases the risk, especially over the long run. Then I measure the operating margin compared to the averages to see if the moat and the overall quality of the business is still intact. And last but not least, I look at the technical indicator for once, namely the distance to the 200-day SMA or simply moving average. This value specifically would have helped me to identify problems with my biggest losers early. If I would have had this rule in place, I would have avoided the biggest losses in companies like Surgical Science Sweden. But it is a bit of a double-edged sword. Because if we look at Google's chart, for example, we see that it dipped below this line several times in the last couple of years. This is also why I give it a bit of breathing room and only give it 1 point when it dips below 10% and 2 points when it goes below 20%. And I'll only use this value if the general market is stable and not below its own 200-day SMA. Because if it does, it's a general issue and not one of this specific company. And none of these metrics alone is enough to take action. It's always a combination of multiple metrics in combination. And of course, I will also do a final check by myself to avoid any false flags due to short-term effects or so. I'll show you this with the example of Texas Instruments in a minute. But first, let's also look at the second category, the position discipline category. I measured two metrics here, the position size and the valuation. So if either my position size or the valuation of the company are too high, but the quality of the company is still good, these positions need to be trimmed. And if both the position size and the valuation are stretched, I even need to trim the position aggressively. Now, such a rebalancing or trimming comes with costs. As Vanguard points out in this paper, when you sell positions, you have to pay taxes on the profits and you have trading fees or spreads that you need to pay. So this should not be done too often. It is also not a way to increase your returns, but a risk management tool. It helps to mitigate the effects of sector-specific downturns, such as the software crash that we had earlier this year. With rebalancing, you can make sure that your portfolio stays diversified over long periods of time. And as the saying goes, diversification is the only free lunch in investing. So all in all, Vanguard concludes that an annual or semi-annual rebalancing is enough. If you do it more often, it just increases the costs without any actual benefits. Now, this specific paper focuses on mixed portfolios with bonds and stocks, but I also found the same information for pure stock portfolios. Now, if this system detects that a company should be trimmed, I will not just go ahead and sell parts of it right away. I will rather go into a defensive stance and do the selling with a trailing stop loss to prevent losing too many gains in high momentum stocks. So the whole system serves one purpose: to stop me from being my own worst enemy. It's about building a system that's smarter than my emotions. But it is a recommendation system, not a hard trigger. The final decision will still be in my hands. So how does this system look with my portfolio concretely? I used Claude Code to build myself a spreadsheet that reflects all these rules that I just showed you, judges my stocks, and puts them into the respective category from the matrix. And this is it. We can see that I get a couple of warning flags here and 3 trimming recommendations. But at least I don't have any hard sell recommendations. And the trims are not because of a too large portfolio allocation alone. They always come in combination with a high valuation. So I will start implementing my reduction of semiconductor stocks here. Nvidia is not flagged for trimming yet because it's still slightly below the 12% allocation threshold and the valuation is even below the 5-year historical values, in contrast to that of ASML or TSMC. The review now flags all come from quality concerns. Either a high free cash flow payout ratio or a declining operating margin like for Surgical Science Sweden. In this case, I get a flag to check the company in more detail. And if I do this for Texas Instruments, for example, I see that the high free cash flow payout ratio is a temporary effect because of the increased capex spending in the last couple of years that are mostly over now and already declining. So, despite the flag, I am not overly concerned. This also shows that the system is not completely automated, but rather indicates stocks that show warning signs and that I need to look at in more detail. So again, the final decision is still in my own hands. Now, what the system doesn't do yet is to check for sector-specific allocations. This is something that I might also implement in the future, but right now I still need to do it myself. So, despite the fact that I only get these 3 trimming recommendations from the system, I will still decrease some other positions from the semiconductor space to get the overall allocation here down. But I will not do it right away, but rather with trailing stop losses to still keep the momentum going as long as it does. And just to be clear, the trailing stop loss will only be for the part of the position that I want to trim, not for the whole position. The rest will stay in my portfolio and I will not touch it. And that is exactly what I did. I already placed a trailing sell order to trim my ASML position, and I will place one more for Nvidia when I reach the 12% portfolio allocation. This in turn will free up some capital that I will use to increase my smaller positions such as Dassault, Surgical Science, Pernod Ricard or Ferrari. But I will not do this brainlessly, but rather stick to my buying framework that I presented last month. If you're interested what this is all about, watch this video next. And of course, this is no financial advice, so please, before investing, do your own research and only use this video as a starting point for your own analysis. That being said, thank you so much for watching guys, and see you in the next video.